everyone, good morning. So we'll quickly start with our today's session. Till yesterday we have completed the basis of property topic, right? I know there are few topics remaining in our book, like in some of the credits are remaining, some of the taxes are remaining, but don't worry, we'll complete our new topic today, this one, and our today's target is gift tax, estate tax, those all things, okay, descendants, final tax return, and remaining small topics which are left, we'll take one more session for that later on. Okay, so let's start with our next topic, that is filing consideration. Filing consideration, in that we are just going to see that what are the deadlines, what are the extensions, what are the due dates, what is estimated tax. Estimated tax is a kind of important topic, because in exam, if you can see, first 50 questions are there, then you have to submit that, and the next 50 questions will be there. In next 50 questions there can be few questions based on the estimated tax topic. Okay, and then how much tax is due, what like if it's due, or if you do a overpayment, how it can be dealt with, and the liabilities and relief. In this liabilities and relief, if you remember, injured spouse, innocent spouse, that topic we left previously in our first session, so we'll cover it today over here in liability and relief topic. Okay, so let's start with our first, filing deadlines and extension. This everyone is aware about the what is the due date of filing the tax return. Filing deadlines are 15th of 4th month after the close of the year, that is 15th April. Extension can be granted in 3 ways. First is automatic extension. Okay, automatic extension is available for 6 months. Right, so 4868 is the form which is which can be filed before the due date. So what is the due date? Our 15th April. So before 15th April, you just have to file the 4868 form as an automatic extension, and you can pay your taxes at that time or pay part taxes, because what will happen that this deadline, this extension is just for filing the tax return, not for paying the taxes. If you pay taxes a little bit of delay, there will be a penalty charged for non-payment of taxes. That penalties and everything is covered in part 3. Okay, so right now you don't have to remember penalties, charges, percentage and anything. This is just the basic criteria which you need to remember, that what is the filing deadline and in what case how much extension you can get. Okay, so 15th April extension is 6 months. In case of combat zone, see, sometime what will happen is, some people might be employed at a contingent zone, right? Like let's say army people are there, they are living at some different location. For them, instead of 6 months, they have an automatic extension of 180 days plus 3.5 month, means 105 days. There will be one question based on this calculation, so please understand this properly. 180 days means I can say 6 months is there. Sorry for the disturbance. No worries. So see, this we everyone know, that is 15th of April is our normal deadline. Okay, so second thing is automatic extension. So you can get an automatic extension of the 6 month from 15th April, that is called as 15th of October. Okay, we everyone know right now it's a deadline for the 1040 return only we are talking about, not about any corporate tax returns. Okay, that will cover in the part 2. Right now you have to just remember the deadlines, extensions, things and every criteria for the 1040 return for part 1. Okay, combat zone, we were understanding this thing where I was explaining that in case of contingent operations, okay, that is basically going to happen in case of armies, those kind of employees, okay, armed force people who are working for public safety, all those people. Okay, so for them, they are not going to live in the same state. Let's say their residence state is California, but they might be placed at some other locations. They might be placed at Atlanta, for example, for providing the services for armed force. Okay, so for them, they have one more benefit, that they can take an extension. Along with this 180 days, they can take an extension of 105 days. Okay, but the thing is here, how you're going to calculate, the main thing is calculation. There will be one question on this, as I mentioned. If this date is before, see, the last date of combat zone, let's say the person is in combat zone till 14th of April. So can I say this is before 15th of April of the respective year? So for that person, if he is returning back, right, if he is returning back before the due date, for him the due date will be 15th April, the original due date I am talking about. But if he is still in the combat zone, let's say he is returning back on 30th of June 2023. for example. So for filing the 2022 tax return, what was his original due date? It was 15th April. So if this date means 30th June is after 15th April of the year, the due date will be the last day in the combat zone, means 30th June, plus he'll get 180 days, plus he'll also get 105 days. But you will have to check what is the last day in the combat zone. If the last day in the combat zone is before 15th April, the normal deadline will apply, means 15th April plus 6 months of extension. But after 15th April, if he is returning back, he will have to check that on what date he is returning. Due date will be the last in the combat zone plus 180 days plus 105 days. Remember the number of days. Do not remember the month, but remember number of days. Month you will remember, if there is one theoretical question, then you can just straight away answer 6 months plus 3.5 months, that is 9.5 months. You can get an extension if the person is returning back from the combat zone. Okay. Next is extension. Individual who is outside US due to military, naval services on duty, lives and maintains main place of business outside US. Okay, let's say the person is having a trade or business outside US. You'll have to travel more often outside the US. So at the time of filing the tax return, if the person is staying outside US, then there will be an automatic extension of 2 months from 15th April. Okay, so from 15th April, along with the 6 months, see 6 months is anyways you are going to get, you will also get the automatic extension of for 2 months extra. Means, can I say from 15th April, you are going to add 2 more months. Okay, so it will be 15th of June. So now let's say if till 15th June you are still not able to file the return, you can take again the automatic extension of 6 months more. So original automatic extension which you can get is 2 months, and then more 6 months you can get. Okay, so that is in case of a person who is outside US. So don't mix up these two things, guys. This is a combat zone, this is a totally different thing, and this thing is you are outside, totally outside US. Okay, got it? This is something which is our filing deadline and filing requirement. Now what is a tax withholding and estimated tax? Whenever you are being employed at your employer's place, you will have to give form W4. Okay, the payer is going to withhold the pension and annuities in the form of W4P. Okay, so no need to remember the form numbers. This is just a thing which we have already done. Payroll taxes is withholding done by the payer. Okay, employer is going to withhold some payroll taxes. Now that withholding which is done, you can get the credit of all those payments. You can get the deduction of taxes paid on your 1040 return. Okay, so other amount on which the tax is not withheld, means maybe it can be interest, it can be dividend, it can be capital. See, on this the tax withholding is not done. If in that case, you have to check what is your previous year tax liability. Okay, if it is 0, then current year you don't have to pay any estimated tax. Take all the tax liabilities total which you have paid in previous year, right? If it is at particular certain amount, we'll check the criteria over here. I know you everyone has done this thing. I'm audible now correctly? So see, in this case, current year minimum tax withholding, if it is 1000, okay, after taking all credits and withholding. See, I'm not going to explain this in detail, but everyone knows that all the incomes minus deductions minus adjustments to income, we get a AGI, right? After that we take some standard deductions, then we take itemized, either standard or itemized deduction, then we take a QBI deductions 199A, right? After that we receive a taxable income. Once we receive a taxable income, what is there? We calculate a taxable income. On that we are going to calculate a tax liability. On this tax liability you can reduce all your credits, because we have already seen that the credits can be reduced directly from your tax liability. Okay, after reducing the credits, you are going to reduce withheld taxes. all the taxes which you have already paid. Okay, and estimated taxes. Estimated taxes means during the year, during each quarter, you can pay estimated taxes. In India, we call it as advance tax, right? Before completion of the year, you keep on paying certain amount as the advance tax. Same way, estimated taxes is something which is based on estimation of your previous year tax liability. So take a 90%, straight away flat 90% of your current year tax liability, or take a flat 100% of your previous year tax liability, whichever is lower you are going to do, and check whether this amount is greater than withholding and credit. So in current year, whatever are your credits and withholding, you have to compare this two amount, right, with the whichever is lower amount. Means here you are going to check if it is greater, estimated tax will have to be paid. Less than, if this amount is less than the withholding and credits, means anyways it is going to offset your tax liability, reduce your tax liability, so you don't have to pay any estimated taxes if your credits and withholding are on a higher side as compared to the lower of this two. Okay, means 90% of the current year tax liability or 100% of your previous year tax liability. You have to remember this percentage. In exam, I'll just I don't remember the exact question, but the exam question, there was one table chart which was given. I know I have explained this in the class also, but for other people, the chart will be given. A tabular format it was given, and it was mentioned that what is the current year tax liability, previous year tax liability. They will give you current year withholding, current year credits, and here there was the options to you need to answer that in what situation they'll give you how much estimated taxes have you paid. So you need to select whether you have paid accurate estimated taxes or not. This was one of the question. Let's say $1,000 you have paid. They'll give you current year liability, previous year liability. What you need to do is take the current year liability, do 100%. Okay, take the previous year current year liability 90%, take previous year liability, take 100%, right? And then compare this to whichever is lower, compare it with the total of the withholding and credits. Okay, if this things is, if this withholding and credits are higher side, and if you have paid a $0 as estimated tax, then it is fine. But if withholding and credits are less than this 90% or 100%, right, then estimated tax need to be paid. Okay, and if you have not paid any estimated tax, then you will be liable for a penalty, underpayment penalty. Okay, what are the due dates for paying the estimated tax? It is quarterly, as I mentioned. Jan to March you are going to pay it on the 15th April. April to May it is next month, 15th date of the next month from the end of the quarter. So Jan to March is one quarter, 15th April, 15th June, 15th September, and for December month it will be 15th Jan. But you are not required if you are going to pay all taxes and files Form 1040 by 31st of January. So actually your due date is 15th April, right? 15th April. But what if you do not pay any estimated tax? You can be saved from the penalty if you pay all the taxes by 31st Jan, file the whole return by 1040 by 31st Jan. Okay, then in that case you don't have to pay extra amount of penalty. Now what is the estimated tax calculation? See, this thing can be asked in the exam, like they'll trick out the question based on the AGI. If your AGI is up to 1,50,000, we will follow the same formula which we saw earlier, right? 90% of current year. See, current year is not going to change, 90% you are going to take. But if your AGI is up to 1,50,000, for previous year you are going to take 100%. But if the AGI, current year AGI, you are going to see the current year AGI is more than 1,50,000, you are going to take 110% of the last year's tax. Okay, current year it is same 90%. For previous year it will be either 100% or 120% depending on the AGI limit. What is AGI limit? 150,000. If it is up to that 100%, more than that it is 110%. Step 2 is, if step 1, see, once you find out now this thing, if step 1 is more than 1,000, then only you have to pay the estimate. See, if after calculating this, the 90% of current year tax liability comes to only I can say $900. Okay, and this comes to $1,000. So whichever lower is what? $900. Sorry, right? So $900 is the less than $1,000. So if this first step is more than 1,000, then only estimated taxes is to be applied. If estimated tax is not paid, then liability will be incurred. Okay, penalty will be incurred. So what it is? take a previous year tax liability, take a current year tax liability, reduce withholding which are allowed. Withholding means all the payroll taxes which were withheld, you are going to reduce it. Federal income tax, right? It is withheld, then you have to reduce it. All the Medicare, Social Security, all these withholdings, you are going to reduce it, right? This amount or previous year tax liability. Now this amount, first you calculate this amount, this should be more than $1,000. Okay, 100% of previous year, 90% of current year, whichever is lower will be your estimated tax liability. If you do not pay estimated tax liability, you will be liable for the penalty. Okay, compare the tax withholding with the estimated tax liability. If withholdings are more, as I mentioned, your withholding plus credits, you have to compare it with the current year plus previous year. Current year, how much it will be? 90%. Previous year, it can either be 100% or it can be 110% depending on the AGI of 150,000. Okay, if withholding is less, then pay the remaining estimated or pay the penalty. Okay, next is tax due and overpayment. See, actually this is a part of your part 3. It's a very detailed chapter in part 3. Here I'll just explain you a little bit of it, because it might happen that like it is included in our part 1 syllabus. So just I'll give you an explanation. Payment plans, if you're not able to pay the taxes, you can request the government for a short-term payment plan or a long-term payment plan. What do you mean by short-term payment plan? That you can opt for installment payment of taxes. Okay, so for installment payment of taxes, you can pay within 120 days or less if you are owning less than 100,000, $1 lakh. Then you can apply for the short-term plan. No need to pay any user fees. You can just it's like paying the EMIs, right? Like direct pay from your account, from your bank account. Each month there will be a fixed amount which will be deducted in the form of the taxes. That is your short-term payment plan. Then there is a taxpayer relief initiative, where you have an option, instead of 120 days, you can pay it within 180 days or less if you are owning less than 2,50,000. Then you can set up this plan without providing any financial statement, or else there is an option of AFS, audited annual financial statement, sorry, not audited, annual financial statement, AFS, which you need to provide it to the IRS on annual basis. Okay, but here you don't have to provide any financial statement. You can take 180 days, means you can take an option to pay the taxes within 6 months if you are owning less than 2,50,000. If you are owning less than 1 lakh, you can go for 120 days. Okay, then we have a long-term payment plan, means instead of 120, instead of 180, if you're not able to pay that taxes in this much time, you can opt for 72 months to pay the taxes. Refund will apply against the amount owed. So 72 months is there, that is more than 1 year. So it might happen that in the next year there is a refund. So that refund you cannot take, but it will be applied against the long-term payment plans. So whenever you file a tax return, today only you can check in the software. Whenever there is a first page of a 1040 return, there is an option which is mentioned, apply this refund. If you have a refund of, let's say, $500, there are 3 options. In what way you want to deal with this refund? You can either apply this refund to the next year's tax liability, you can apply this refund to the long-term payment plan, or you can take this refund as a direct deposit in your bank account. So these are the 3 options which you need to select, and whenever you have a refund, now you have to select any one option of this. There will be a diagnostic otherwise. Okay, so I'm not going to go into very detail. Let's come back to our revision session. So 72 month is the third option. Guaranteed installment is there, where if you are owning only up to $10,000, the IRS will accept the request. There is no option, there is no chance that they will reject your request. If you are owning up to 10,000, you can pay it in installment. And the thing is, during past 5 years, the taxpayer has timely filed all the tax return. All means I am not saying about 1040. It includes payroll taxes, it includes sales tax. All types of returns are filed on the timely manner during previous 5 years. Okay, and the person is going to agree to pay all the taxes within 3 years. Okay, next is streamlined installment agreement. If you are owning less than 50,000, you can go for this. That is streamlined installment agreement, means your balance is more than 25 and up to 50,000, you can make an automatic monthly payments, or you must complete an annual financial statement. So here AFS is required. okay, or agree for a direct debit installment agreement or a payroll deduction installment agreement. This thing I hope I have explained already in the class, that you can ask the bank, when you're applying, at that time, just like your EMI is auto debited, this is your direct debit, auto debited, or payroll deduction means your employer will receive a notice that while paying the salary to this person, you have to deposit this much percentage to the IRS in the form of automatic payroll deduction amount. Okay, so in any of this installment agreement you can opt for. Second thing is you have to file a AFS. If you're not filing the AFS, you have to opt for any of this too. If you're not doing any of this, you have to make the automatic monthly payment, auto debit you have to on from your financial institutions. Okay, that is streamlined installment payment. Other one was guaranteed. Up to 10,000 is guaranteed. More than 25 up to 50,000 it is streamlined. Okay, what do you mean by non-streamlined? If you want to go for more than $50,000 for like let's say there is a huge amount of tax and penalties which is there, so you can opt for going for a non-streamlined. Means if taxpayer owes more than 50,000, then they cannot file form 9465 electronically. 9465 is nothing but application for the payment plans. Okay, they cannot file it electronically, they will have to paper file it, plus taxpayer needs more than 6 years to pay. You can get more than 6 year time to pay, plus taxpayer completes form 433F as a collection information statement. Don't have to remember all this. This thing is very well covered in part 3, and part 3 those who have already attended few sessions of the part 3, I can see we have already done this in part 3. Okay, so no need to right now stress out in part 1. Just remember that in case of non-payment of the taxes, you can opt for the payment plan. What are the types of payment plan? One is short term, one is long term. In short term, we have two options, 120 days, 180 days. In long term, we have 3 options, that is guaranteed installment up to 10,000, streamlined installment up to 15,000, non-streamlined is more than 50,000, but this has to be always paper filed. Okay, along with the paper filing, there are some other requirements which need to be met. No need to remember it, it's for part 3. Okay, maximum collection period is what? 120 months. Payment method are same as we saw over here. Okay, direct deposit, direct debit installment agreement, direct pay from saving or the checking account, EFTPS, check, money order, debit, credit card, by any way you can pay it within. Maximum collection period is 120 month. Okay, next is overpayment. What if you are overpaying? Is, as I mentioned, you have 3 options. You can apply the estimated tax payment for the following year, for the next year. For that, you need to have to file a request by a separate form. You can also be using that refund to buy a saving bond, that is series I savings bond. You can apply it for that. Or third one is you can also apply the refund for the direct deposit to the traditional IRA. So Roth IRA or all this IRA, if you want to make the contribution for the next, so it will be considered as a contribution made. It will be considered as a contribution made in 2023 tax year. Okay, if you are paying it, if you are filing the return in 23 and if you receive a refund, you directly applied for the traditional IRA, it will be calculated for next year. Okay, that's 6,000, 7,000 limit. Filing a claim for refund, you have to file a claim for refund separately if you are not taking a direct deposit within 3 years from the date of filing the original return. Even if the return is filed in the extended due date till 15th October or 15th April, you have 3 years. Okay, the date will be the original date only, or 2 years after the actual payment of the taxes. Means whenever you paid the withholding taxes, whenever you paid the estimated taxes, that is the actual payment of taxes, that date or the due date when you file the return, whichever is later, from that you have to calculate 3 years. Till that time you can file a claim for refund. If you have a bad debt, right, and you are amending the return, the 7 years will be considered in that case. Okay, if the credit or refund is less than the taxes paid within 2 years immediately before filing the claim. Okay, what I'm trying to say is, here I know this topic is little bit of easy and complicated also, but you have to understand the time durations, time limits and all. Okay, just draw the timelines every time when you receive the number of years kind of thing, or phase out limits. Okay, so if the credit or refund which you are applying for, right, it is less than the taxes which you have paid within 2 years immediately before filing the claim. Let's say you are filing the claim here, so back calculate the 2 years, check how much total amount of taxes have you paid, and check that if the taxes paid within this 2 years before filing the claim is claimed, if refund is claimed after 3 years but 2 years after paying the tax. Means simply I'll just sum it up in simple thing is, you have the from the date of filing the claim back calculate 2 years, or from the date of filing of the claim, from this date check 3 years ahead, go back first 2 years and come 3 years ahead. Okay, so check whatever you are going to ask from IRS. First of all, you should have at least paid that much amount. You should not ask more than what you have actually paid. That is simply it is saying. Okay, so no need to stress out right now on all this, but since it is included in part 1, I'll explain it. If erroneous refund is claimed, okay, you have claimed extra refund which does not have any meaning, and you do not you do not provide a proper explanation for that error, then you will be liable for the penalty of 20% for that thing. Okay, got it guys? This was about it. This was about the estimated taxes. This was about overpayment, filing a claim for refund, right? What are the options if you are not able to pay the taxes? I know many of you have just understood, just done one thing, 90%, 100%, that's it. The estimated tax topic is done. No, there are so many things in the estimated tax topic. Please go through this book. Okay, if you don't want to go through the whole GLEM theory, at least do this much, not the whole thing. Okay, now next is liability and relief. This we have already done in the class. I just explained in very short manner. Joint and several liability, right, and second is the injured spouse relief. First is innocent spouse and second is the injured spouse. In innocent spouse, simply you have to link the topic with the income reporting. Means once the income is reported and now the IRS sends you certain notices about you need to pay extra taxes, or you need to pay extra liability, or you need to pay penalties or interest or something, but the spouse was not aware about what all incomes were reported, or she is not earning at all, that earnings are not her part, right? So she will be called as an innocent spouse, and she will not be liable to pay the extra taxes, extra interest, penalties. Once they receive the notice, what she will do is she will directly apply for the innocent spouse relief. So income not reported or reported in a wrongful manner by the spouse, for which the taxpayer is not aware about. Okay, means spouse is not aware what incomes were reported. So spouse of a former spouse failed to report the income. Let's say this mainly will happen in the divorce cases, right? Spouse or a former spouse failed to report the income, or reported wrong income, or has taken a wrong deductions or credits, and due to which now they are receiving the notice. Because initially what was there, they were married in 2021, they filed MFJ. But now in 2023 tax year, they are divorced, and now they receive the notice. When they receive the notice, it will be in the name of both the taxpayer and the spouse. Spouse says that I am not aware about what all incomes were reported at that time. Okay, so this is that case which we have already done with an example, right? A taxpayer will have to use a form, which is, you can remember this form for the specific topic, that is 8857, to request a relief provided he meets all the following conditions. 3 conditions are there. First is spouse must have filed the joint return. See, if joint return is filed, then only there is a joint and several liability when the notice will come. So the spouse must have filed a joint return with an understatement of tax liability related to the spouse's erroneous item. Okay, means whatever notice is going to be received for that particular return, it has to be filed in the joint by both the taxpayer and the spouse. Then only the spouse can go and apply for this innocent spouse relief. Okay, next is taxpayer seeking relief can establish that at the time he signed the joint return, he did not know about all those errors. So the spouse will have to mention that in the form and agree that at the time of signing the return, she was not aware about all these things. Okay, then there was an understatement of tax. At that time there was an understatement of tax, she was not aware about it, and she just signed the return to file a joint return. Okay, third is taking into account all the facts and circumstances, it would be unfair to hold the taxpayer liable for the understatement of tax, and that is why if these 2 conditions are fulfilled, she can easily file a 8857 form and take a innocent spouse relief for not paying the extra she is not now liable to pay the extra interest penalty which is mentioned in the CP notice. Okay. Next is CP notice is computer programming notice, which you will see a lot of detail in part 3 about it. Okay. Next is separation of liability relief. This question can be asked. The innocent spouse relief will also be defined as a separation of liability relief or equitable relief. Okay, separation of liability relief is nothing but it just mentions that for those who are no longer married or widowed or legally separated and have not been members of same household for 12 months. It might happen that a person are living, they are still not divorced but they are living separate, right? And previously they have filed a joint return and now they receive a notice, but now they are under a condition of separation of liability relief, means they are not living in same house for 12 months. Then the understated taxes plus interest plus penalties on the joint return is allocated between the spouse and the taxpayer. Okay, then the tax allocated is generally the amount the taxpayer is responsible to pay. Now, this type of relief is available only for unpaid liabilities resulting from understated tax, or refunds are not allowed. You will get only the relief. See, based on this, you can't say that 2 years ago we filed a joint return and I also paid the taxes. It might happen the taxpayer and spouse both are married. Spouse is not working anywhere, only taxpayer is working. But since they filed a MFJ, right, she cannot go and ask for the refund for her part of taxes. That is a separation of liability relief, that refunds are not allowed, but she can get a relief of any penalties, interest, which is newly now leviable based on the previously filed return. I hope everyone is understanding this. Okay, equitable relief is nothing but for properly stated but underpaid taxes. If a taxpayer does not qualify for other form of relief, means either she is not qualified for this and for this, then she can go for equitable relief. The taxpayer must still be relieved of responsibility of tax, interest and penalties. So these are the three main categories under the conditions of innocent spouse relief. Okay, if you're reading from the Glen book, if you do this much chart, that is enough. No need to read the whole theory again and again. Just understand the meaning of these three terminologies, understand what are the criteria mentioned over there. Okay, next is injured spouse. Now this, think as if this is something which is related to refund, means my part of refund is not provided to me only. Means now here the taxpayer, what taxpayer is saying is, I earned all income, I paid all taxes, and when I'm receiving the refund, it should not split between both of us, because she is not earning at all, she is not paying any taxes, I paid the refund. So now the taxpayer is claiming as a injured spouse, means all refund for my earnings should go to me only. It should not be divided with my spouse. That is what it is saying. When a liability belongs to one person, right, to one spouse, a taxpayer is a injured spouse. If he files a joint return and all part of his share of refund, right, I filed a joint return with my husband for example, and I am only earning, I am paying all the taxes, and now when the refund comes, it is applied against the spouse past dues, right? So it is not not a fair thing, right? I am earning, I am paying taxes, so I should get the whole refund in my account instead of applying that refund to my spouse previous taxes. Okay, so that is not allowed. An injured spouse may entitled to recoup their share of refund. If it is applied, what you can do, see, at the time of application of this refund, it is all computer processed. You can once you file the return and now you want to take out those refunds and apply it to your liability, then you can go for a injured spouse relief. Okay, you can recoup those share of refund. So injured spouse relief can file a 8379. Remember why I am mentioning the form numbers. They can ask for 1 marks or just a simple question for the form. Injured spouse relief will file. See, let's say they'll give you a scenario. You have to remember whether it's income related, income reporting related, or whether it is refund related. Okay, if it's refund related, what you're going to file is 8379. That is for injured spouse. If it is income related, the penalties and all those related, right, already reported income when you receive a CP notice, and for that you need to take a relief, you are going to file 8857 form. Got it, guys? So this is all about it. I'm not going to read the whole theory. Please go through it. I've already explained the concept. Okay. Now quickly let's move to the next important, most important. Right now, today's session, whatever we are doing now, most of the questions from today's session will come in the next 50 questions. See, as I mentioned, first 50 will be there, next 50 questions will have a lot of questions based on estimated tax, on the injured spouse relief, innocent spouse relief, specialized return, gift tax, estate, final return, foreign tax related topics. 2-3 questions will be there. Okay, so please concentrate right now. I know we have done this topic very well in the class, but still right now we will be doing it, the revision, in very quick manner. I'm not going to explain it in very detail. Okay, so first of all, the thing is, for gift tax, we are going to use form 709, and for estate tax, we are going to use 706. So don't confuse about the form numbers. No need to remember the form numbers. Just understand the concept. In case of gift is something which a person is alive, and if you're gifting something to some other people, right, let's say cash or in kind, if you're gifting it, and if the value is up to 16,000, no need to pay any gift tax. But if the value is up more than 16,000, you have to pay a gift tax. You have to file a gift tax return for that particular year. Okay, and this 16,000 limit is per person. So let's say if you're filing a joint return, right, I've explained that thing very well in the class. If you file a joint return, both have a limit of 16,000, but let's say the taxpayer want to gift a certain amount to their relative of, let's say, 20,000. So he has the option to use only 16,000 as a limit. But what about the remaining 4,000? He will have to ask his spouse, can he use his limit or her limit of 16,000 or not? Why? Because we'll see the reason for this, we'll see later on in this section only. Let's check. Okay. First thing is, the gift tax will be applicable to whom? First thing is, it applies where there is a transfer of a property, where the gift is made when the taxpayer gives the property in the form of cash, income, tangible property sold at less than FMV. So let's say I'm gifting my sister a particular property. Remember the yesterday's example, basis of property, we saw that I gifted a property to my sister for a lesser value. Well, let's say 7,600. The price was 10,000. Right? I am gifting it as a less than FMV. Then also it will be called as a gift. And gift will be how much she paid, I'll reduce it by the FMV value. That much will be considered as a gift amount. Okay. Interest free or reduced interest loan, if I give it to someone, right, then it will be also called as a gift. Future interest are also a gift. Let's say I provided a particular FD, and when it is going to mature, my relative is going to get, my dependent is going to get that amount. So that is the interest. It's a future interest gift. Okay, future she is or he is going to receive the benefit. Okay, non-taxable gifts, very well, you will have to remember these exceptions. Based on this only, there will be one question. Only one question will be there, but you have to remember this. Gift of future interest is not a gift, means it, in case of calculating the gift tax, you are not going to consider this. This we have seen in the class. Please go through the theory again for this topic. Okay, gift up to the value of 16,000. So this is, see, for people who have already bought the book previously, this thing I am talking about specifically for them. Just apply your logic. If here it is already mentioned 16,000, on next page due to some typical error, instead of 16,000, if it is mentioned 15,000, you should understand that it should be 16,000. It should be 16,000 right over here. Don't do the screenshot and send me that the book is not updated. Okay, so for all those who sent me the screenshot, 2-3 people, you should apply your mind, and if you have done the regular studies, you should know that here if it is 16,000, there should also be a 16,000. Okay, and this is specifically handwritten by me. I am not outsourced the book work to someone else. Okay, so at least understand that thing. There can be some typing error or anything, so you should change by yourself. Okay, so let's move to the next topic. First is, what are the exception? What all gifts are not taxable? Gift of future interest. Second is any gift paid which is of value less than 16,000. Third is medical expense or tuition which is paid directly to the medical institution or education institution. Right? If you are paying, see here one more topic we linked in the class, that was regarding QTP. right? If you front load the amount into qualified tuition program, so that is also called as a gift. Now you are paying something, but if it is for the education purpose, you have to check that it has to go directly to the education institution. It has to directly go to the medical institution, medical organization, okay? Whoever for whom you are incurring the medical expense, you should not pay the cash to that person and then he is going and taking the treatment. No, you should go and pay directly to the medical or hospital facility, okay? And second is for educational institution, okay? Here there is no limit. Let's say you deposited 25,000 or 50,000, there is no limit and it will not be liable for the gift tax, okay? Next is gift of marital interest, means at the time of marriage, right? After marriage, if a taxpayer is gifting something to the spouse, then it is called as gift of marital interest. There will be no limit for this purpose. Gift to political organization for its use, it will not be called as a gift and no gift tax will be leviable. But remember this thing, political organization, if you're gifting something, donating something, you will not get any deduction for charitable contribution. There was an exception if you remember the itemized deduction topic. Gift to charities is something which is already taken in schedule A as a deduction. So here you don't have to consider it as a gift tax and pay the taxes again, because IRS has given an exception that it will be included in the charitable contribution as a deduction. So on the other end, they will not make it taxable. Okay, so these are the few deduction you have to few exceptions which you have to remember, which are non-taxable gift. Okay, now the important is lifetime exclusions and credits. Here you have to remember that the liability, gift tax liability can be reduced, and this is a lifetime exclusion. That is why when I mentioned the taxpayer will ask the spouse to make the reduction of this 4,000, the reason is the spouse is also having her lifetime gift exclusion limit of 12.6 million. There will be straight away one question that what is the lifetime exclusion limit for the gifts. Okay, previously it was 11 point something million, but current year for your exam purpose, those who are going to appear in October, December, Jan and Feb, for them it will be 12.6 million. Okay, so this, as much as you take the reduction, let's say 16,000 you excluded, so 16,000 will get reduced from here. Next year again you take a 16,000 of gift tax exclusion, this 16,000 will again get reduced, because this limit will be checked when a person dies and all the assets are getting transferred to the estate. At that time FMV is going to be considered. We'll see that when we do the estate topic. I'll link this again today only in the estate tax topic. So right now just understand the lifetime exclusion limit and credit for gift tax is nothing but 12.6 million. Okay, and for gift tax liability, so once you understood that this much amount you have to pay, means, can I say, if in particular year you contributed 20,000 and your spouse denied, don't use my limit, I want to keep my 12.6 million intact, I don't want to reduce this amount at all. So what the taxpayer will have to do, they will have to take an exemption of 16k, and for remaining 4k they will have to pay the tax, gift tax. We'll see the percentage also, but on this 4,000, whatever gift tax percentage is there, that much gift tax can be reduced. The exemption the person is going to get to pay the gift tax is up to 479,800. This is also a lifetime exclusion. So if you remember in the class we have done that you have a balance in case of tax liability, you have a balance of 469,800. Each year whenever you are going to take the exemption, you have to reduce that much balance. Okay, and this balance will again be used at the time of death of a person, because this is a lifetime exclusion. Okay, and this limits keeps on changing each year, so those are going to appear in the next window. Please go through the amended sessions. Do not rely on this limit. This, I am giving a disclaimer, this is for 2022 tax year. Okay, next is exclusion. Annual exclusion is 16,000. As I mentioned, if you are married you can take a 32,000. Half for each spouse can be taken. If gift to a person is given. Okay, and both will have to file a separate 706. 706 has not any, does not have a clause to file a MFJ return. MFJ is there only for 1040 return. If they both are going to provide a gift, going to give a gift, they have to file a 706 separately. There is no provision of filing a joint 706 return. Okay, exemptions and reductions. What was the exemption? Medical, education, political contribution. No need to file a gift tax return. Okay, marital deduction will be allowed, but if the spouse is a non-US citizen, right, and in that case, if the gift is given above 159,000, then it is taxable. Okay, no need to remember the limit. Just understand for gift tax, these limits are important. 16,000 is important, 12.06 is important, and the gift tax liability limit is important. I know this is a little bit weird figure, like 479,800, but you have to remember it. There is no option. Next is charitable contribution. No need to report it if there are no other reportable gifts. This, the reason I am explained it very well in the class, giving the example that if I have a charitable contribution, right, and you have a gift, no need to report if there is no other reportable gifts. But if there are then you have to report other gifts plus charitable gifts both and take the deduction on 1040 as a charitable contribution. Okay, deductible gifts made to the charitable will include taxpayers' entire interest in the property or a qualified conservative contribution program in which you have just put some amount as an escrow, and later on you are going to make a whole contribution of the property. So this thing is about that, about the escrow accumulation and then paying it for buying a particular property and then donating it as a gift. Okay, next is gift of future interest. Now this is something which cannot be excluded from annual exclusion provision, means that 16,000 provision will not apply for future interest. That was mentioned in the above two paragraphs. Okay, any gift of future interest are reportable, always it will be reportable in form 709. Just a minute, 709 is there, somewhere it was mentioned as 706, here it will be 709. Okay, next is contribution to qualified tuition. So this is important, we have already done this topic, right? 529 plan, where you are going to contribute a particular amount. There were two plans for education, 529 plan was there and one was QTP, qualified tuition program was there, right? So over there in 529 plan, you can consider a complete gift of present interest. Since this is a future interest, can I say this will be utilized in future? So this is a gift of future interest. So donor can front load the QTP with 5 years and will be allowed the exclusion of 75,000 worth of annual exclusion. But instead of here, just make it 16,000 because now the limit is 16,000 into 5 years. Right, so you can front load your QTP by 5 years. So in that case, how much deduction you can take is 16,000 into 5. Amount of contribution can be excluded in each of the 5 years. Okay, for each of the 5 years you can exclude depending on that particular year limit. So let's say till previous year the limit was 15,000, so you can deduct 15,000, but next year it is now 16,000, so you can deduct 16,000. Let's say next year it is 17,000. Actually for 2023 it is 17,000 as a deduction for annual exclusion of gift tax. So you will deduct 17,000 in the next year depending on whatever is the annual exclusion limit. Got it, guys? Next is generation skipping tax. This is what we have understood is whenever you are skipping your generation. Let's say my grandfather has gifted me something, so he has skipped the one generation, he has not taken into consideration my father and then he gifted something to me, right? So that is called as generation skipping. One generation is skipped and then you are going to receive a gift. So if donor has skipped two or more generations below the donor and recipient is not related to donor, or if they are related, then the age difference between my grandfather and me is less than 37.5 years, right? Then in that case it will be liable for generation skipping tax, which is fixed 40% rate of generation skip. GST is flat 40%. Okay, so effective generation skipping tax exclusion will also be available, right? For gift tax, for GST, all of those you can take annual exclusion and it can be taken as a lifetime exclusion for 12.6 million. This is a lifetime exclusion. Okay. Next is filing a gift tax. On what date you have to file? There will be one theoretical. See, as I mentioned, in the second half of your exam, second 50 questions, there will be this small one-liner question where you will, you will easily able to answer those questions. That 15th April is a due date. The lifetime exclusion limit is 12.06. This one-liner questions will be there in few of the papers. Okay. Next is tax rate is maximum 40%. As I mentioned, maximum 40%. It can be reduced also depending on your slab rates, but maximum you have to remember is 40%. They will not ask you tax rate. If gift is more than the annual exclusion limit of 16,000, then you will have to file a gift tax return. Right now, what we are understanding when you need to file a gift tax return. Okay, if taxpayer and spouse are splitting the gift, so 16, let's say 20,000 is the total gift which is given by the taxpayer, but now they want to split the gift, means 16,000 will be taken as a deduction by the taxpayer and 4,000 will be taken as a deduction by the spouse, as an annual exclusion by the spouse. So both will have to file the separate gift tax return. Okay, 709 form. Then taxpayer gives the gift which contains future interest. Even though the 16,000 exclusion will not be applicable over here, but still if you are going to give a gift of future interest, you'll have to file this return, that is gift tax return. Okay, next is next one is taxpayer give the gift of it. Okay, taxpayer gives his spouse an interest in property that some future event will end. Okay, interest in property is given and in future that gift will be revoked, I can say. Then also you'll have to file the gift tax return. Okay, now let's understand quickly about the estate tax. This we have done very well in the class. If you guys remember that the gift tax and the estate tax is little bit linked, because during the lifetime your account is there, right? Your annual exclusion is there, that will get reduced from your total lifetime exclusion amount, that is 12.6 million. At the end of your life, whatever is the balance remaining in that account can be applied at the time of paying the gift tax. Okay, so the simple rule was, whatever asset the taxpayer is having, the taxpayer dies, all the cost, property, land, stock, other asset will get transferred to the beneficiaries, right, at FMV. Even though it is valued at cost, but it will be transferred to the beneficiaries at FMV value. Basis for beneficiary for this asset. Wait, first, before understanding the estate, let's understand the descendant, final descendant return. Just a minute, guys. Yeah, see, once the gift and everything is done, now what happens? A person dies. Now in the year in which the person is dying, in that year you have to check if that person was married during the whole year. So on 31st December, right, his status will be MFJ. The widower, whoever is the spouse, the status of that spouse will be MFJ if she doesn't remarry again to someone else. Okay, before the end of the year, you have to check the status. Okay, so for that descendants means the person who is dying. Okay, the taxpayer who is dying plus the spouse will file a joint return in the year of death. Okay, that in that case, for that particular taxpayer, it will be a final return. It will be a final return. So whatever income that person might have earned, he will be paying, like his beneficiaries, his spouse or whoever are listed representatives will be paying the taxes on the final return for income which he has earned. Now what happens now, sometimes a taxpayer might be having accrual basis of system, right, accrual basis of accounting, which the taxpayer might have followed. Now after his death, he is still receiving certain accounts receivable. Okay, so you have to determine whether the person has been following accrual basis or cash basis. If a person is following accrual basis, then in that case, later on when he is going to receive the amount, right, he will be we are going to include that amount in our tax return if it's an accrual basis. If it's a cash basis, then whatever amount has been received till the time of death, only that much amount will be included. After the death, whatever income is being earned will all get transferred to estate, and estate will be including it in their income, will reduce some expenses. We'll see what all expenses can be reduced, and remaining you are going to pay the estate tax return. Okay, got it guys? So simply remember, in case of the final return, descendants final form 1040 and income tax return must be filed for a descendant, the person who is dying, if the descendant met the filing requirement at the time of the death. The deadline is, this one question will be there, what is the deadline in case of the descendant's final return? It will be same deadline as that of the others, that is 15th April. Okay, same way for the gift tax also, it is the 15th April. You have to remember few deadlines. Okay, person responsible who will be responsible for filing the tax return, it will be surviving spouse, it will be relative, it will be executors, administrators, or a legal representative. Okay, if a taxpayer died between Jan to 15th April, so can I say he was alive for the previous whole year, previous whole 2022 tax year he was alive, then he is not going to file a, we are not going to file a final tax return, but he died in 2023. So when you file a 2023 tax return, that will be your final tax return. Then in that case, see, you can read over here, 2022 tax return will not be the final return, as a descendant was alive the whole tax year and died in the new tax year. So the final return will be for 2023 tax year. Okay, spouse, surviving spouse, if she is not remarrying, then file the joint return with the descendant. If she is remarrying, she will have to file a MFJ with the new spouse. And for the old spouse, means who is dying, for them we are going to file a MFS return for the descendant spouse, and that will be a final return. Check mark will be done on the box on as a final return. Okay, court appointed a representative. The representative can revoke the MFJ status. If court has if there are a lot of assets and some taxes, liabilities, and everything is been accruing on that particular taxpayer, and now is dying, the court may appoint a representative. That representative may ask the spouse to file a separate return, even though she didn't remarry with someone else. The court representative will advise to file a separate return because of some tax liabilities and all those things. Okay, now whatever income which will be taxable for the beneficiaries will be called as income in respect of descendant. All income that descendant would have received had death not occurred, that was not properly included on the final return. Means, can I say, if they are following, if the particular person who died has followed the cash basis, right, then up to the date of death, whatever cash has been received will be included on the 1040 final return. But after the date of death, whatever income they are going to receive will be included in the estate return, and this income will be called as IRD, income which is in respect of descendant but will be included in the estate return. So what it is saying, all income that descendant would have received had death not occurred. If death would have not occurred, then whatever income now which he is receiving, right, is called as the income in respect of descendant. Here the two methods are mentioned, cash method, accrual method. There will be one MCQ based on the dividend, or maybe I can say interest, that it is declared. And if the person is using, say dividend is declared, person is using cash method on the, and the death occurred and after that he received it, do not include this dividend in as an income in final return, but on the receipt date it will be included in the estate as an income. Okay, income in respect of this will be called as IRD, income in respect of descendant. So cash method, in that case, interest if constructively received before that, means you have received the check. You know the meaning of constructive receipt and other than constructive receipt. You have received the check, right, before the death, but you have not encashed the check, so it will be called as constructive receipt before death. Received but not cashed, that is your constructive receipt. Dividend is declared and received later on. See, if this receipt date is before that death date now, then this will be called as constructively received. Okay, then in that case it will be included in the 1040 final return, but right now it is included after that date, so it will be included in the estate income. Okay, income in respect of descendant, capital asset, receive a step up, means those all properties and assets which are capital asset for the taxpayer will receive a step up, means it will be valued at a FMV. What is step up? Cost minus FMV is a step up which is going to be given to the asset. Okay, and whatever is the cost minus FMV, this much is the step up. This will be compared with the limit which the taxpayer is still having in his balance, right? 12.6 million, how much he is having, that much amount, the balance will be reduced and it will be zeroed out. Whatever is still remaining on this, they will have to pay a gift tax. Got it? Other asset, there will be no adjustment to the basis. IRD will be included in the income of the descendant's estate. It can be possible that the estate will get included in the income, or if the beneficiary is directly receiving the income, it will be included in the beneficiary's income, or any other person who is receiving the income will be included in their particular income. Okay, next is accrual method. In case of accrual method, all income when earned, any income accrued before the death will be included in the final return. Okay, as I mentioned in case of accrual method. Next is in case of final descendant return, the next is if the medical expenses are incurred for that particular descendant, if it is paid before death, you have to include it simply on the schedule A as the medical expense. If it is not paid before death, then you have to include it in the estate return as a liability. See, it might happen that the person is going through so much of medical treatments and everything, but the payment has accrued but it has not yet paid. After the date of death, it is paid. After the date of death, if it is paid within 1 year, then it can be included in the tax return of the descendant, the 1040 final return. If within 1 year it is not paid, then it will be included in the estate return and can take the deduction. The estate return, in that the medical expense can be taken as a deduction. Okay, we have loss deduction, we have credits. Loss deduction, annual from the prior year will get carried forward, capital losses, capital loss carry over. But in case of final return, the final return is the last return in which you can take all the losses and settle it off. Whatever is remaining will not get carried forward to the estate return. Okay, same way for the credits, all the credits can be taken as it is, but if there are some non-refundable credits, or see, there can be some credits for which the conditions are not fulfilled, like child tax credit or anything, but you have to compare as if you have to assume that as if the taxpayer was alive during the whole year. Based on that assumption, you have to calculate the credit and take all the credits on the tax return. Okay, terrorist or military action related forgiveness, in that case it will not be taxable to descendant, or estate distribution also it will not be taxable. This thing applies to, see what happens if a person dies and if they receive certain distribution from the terrorist or a military action, due to that the person dies, and for that if you receive any forgiveness, you receive any income, you receive any money, the family receives certain distributions, then in that case it will not be taxable. But that thing applies to the member or US armed force at death, dies from the wound or injury incurred. Year of death, it will not be taxable. Year of wound or injury, it will not be taxable. 1 year prior to the wound or injury also, if you receive such kind of payment, it will not be taxable. Okay, got it guys? Now let's look at the estate return. You understand the concept, like whatever a person dies, all the asset will get transferred to the estate. Okay, so all the FMV minus cost is the step up basis on which the person will have to pay the taxes after reducing the balance limit from 12.6 million, and then whatever is the tax, you have to compare it with the credit for that tax payment, you know, 469,700, that much amount. Okay, that much after reducing whatever is the remaining, you'll have to pay the taxes based on the 1040 final return. So all the FMV, it will get transferred. FMV on the date of death. See, FMV on which date you have to take. Either you can take it on the date of death, or you can take it on the alternate valuation date. We already know what is alternate valuation date is 6 months from the date of death. But let's say before 6 months, if the asset is sold, right? So the value on the date of not sold, actually it is distributed to beneficiaries. So before the 6 months, if it is distributed, so FMV on the date of distribution will be taken into consideration. Okay, for trust there will be a trustee. For estate, that will be called as an executor. The trust topic is there in your part 2. Okay, estate is there in your part 1. Okay, trust is something which is created when you are living. Living trust is there. There are simple trust, complex trust. All those we'll do when we do the part 2 revision. So those who are going to appear for 2 parts together, make sure you join from tomorrow for part 2 also. Okay, those who are not going to appear for part 2, please do not join and keep on revising the part 1 again and again. Okay, fiduciaries will hold the property asset of the beneficiaries, and whatever income is generated before passing the property to the beneficiary will be reported as, for estate will be filing it as the estate tax return in the form of 1041. Now see, the whole link I have explained in the class. I'll just explain it quickly. Just a minute. What happens if a person dies now? This is the basic rules which you have to remember. This is the flow, I can say the flow of preparing the return. The person dies, and that year you will be filing a 1040 final return. Okay, final return. When you are filing a final return, after that you have to you have to transfer everything into the estate and pay the estate taxes. Okay, but now what happens, it's not possible to distribute each and everything on the date of death. So it might possible for distributing the asset, it took 2 years or maybe 5 years. So what about this asset? This asset might be generating certain income. So during the year in which they are generating the income, you will have to file, whoever is the executor of the estate will be responsible. So the executor will have to file a estate tax return. This is a one-time tax payment which is done by filing form 706, right? But for the every year generating income, you have to report that income to the IRS. You will filing a form 1041 every year for the existing estate till the time it is getting distributed. So that is called as form 1041 estate income tax return. Trust will also be filing the return, that is trust income tax return. Again, I'm saying it is for part 2. Don't stress out right now on trust topic. Okay, example is estate or trust generated an income of 6,000. Out of this, 4,000 is given to the beneficiaries. So 4,000 is distributed to beneficiaries. Either of them will pay tax on 4,000 and the tax on 2,000 will be paid by the fiduciary by filing form 1041. Got it, guys? So whatever is distributed now, that much income will be included in their individual tax return. But if it is not distributed, it will be included in the 1041 form and it will be the responsibility of the fiduciary of the executor to file the return for the estate. Okay, got it? I hope you understood the flow. And when he's alive now, whatever gifts he has made, he will be filing a 706 form. Plus he will also be filing a 1040, of course. Okay, next is, yeah, the limit, as I mentioned, I'm not going to explain it again, but the limit of 12.06, whatever is remaining in this, please change this. This is 12.06 again. There might be few pages where the amounts are not changed, but few pages that are changed. Please apply your mind and change it accordingly. Okay, or at least follow what I'm changing in the class. Okay, so 12.6, 12.06, and each year they have the limit of 16,000. So whatever is the 16,000, whatever in your whole life, this 16,000 which you have taken, you have to reduce the balance of your $12.6 million and whatever is the remaining, right? See, here it is there. Keep a recurring account. It's a recurring account on the amount where the amount is not going to increase, but yeah, it will increase. Let's say previous year it was 11.7, now current year it increased to 12.6. So whatever is the difference between these two, you are going to include it. Okay, so keep a recurring account on amount every year given as a gift. Okay, next is reduce the accumulated amount of gift given during the lifetime till the date of death, and after that the balance is left. From this 12.6 will be considered as an exclusion. Now how you are going to calculate the estate tax? Let's calculate it. And the second reduction which you are going to get is for the credit. Okay, so FMV of the property minus deduction allowed, amount liable for estate tax. Out of that, you are going to reduce the unused amount from 12.6 million. So that is your net estate tax, which an estate which is liable for tax. Multiply it by the rate, estate tax rate. This is your tax liability. After this, use the unutilized amount from your credit. So this much is the maximum estate tax liability which you are going to pay. Okay, and when this asset is getting distributed to the beneficiary, now they will get the deduction of whatever the liability paid, already paid by the estate. That much proportionate amount they can take the deduction. Okay, unused exclusion amount can be transferred to the surviving spouse. Following deductions are allowed from the gross estate. They can take a deduction for funeral expense, debt owed at the time of death, administrative admin expense, marital deduction. Let's say taxpayer is transferring one property to another spouse due to the death occurrence. So this is a kind of gift which is already a gift tax exclusion. We have seen this. Charitable deduction, but here one thing you have to add, if it is mentioned in the will, if it is mentioned in the will of the taxpayer that after my death I need to do this much charitable donation to this particular organization, then only that charitable deduction can be reduced. Right, by the will of beneficiaries, if they are donating something, some estate of the taxpayer, if they are donating it, that is not allowed as a deduction. Okay, it should be mentioned in the will. Okay, state death taxes deduction. Some state they charge a death tax also. So you have to deduct that tax. Losses due to casualty and theft at the time of transferring, let's say before transferring the asset, there is certain casualty and theft for the in the property, and due to that there is a loss, right? So that deduction can also be taken over here. Next is following credits are also allowed. Credit for foreign that tax is paid. In foreign, if you have paid any some death taxes, then credit for federal gift tax paid. Okay, gift tax paid, taxes on prior transfers. Okay, all those deduction can be allowed. Now this thing is not that much important, but just understand this. Descendant received a gift. Okay, on that day estate tax paid will get credit. Whatever estate tax are paid will get credit. Before 10 years from the date of gift, descendant received a gift. Okay, before 10 years, person who gifted died. Okay, so now he is going to receive, after 10 years he received the gift. Second thing is, when he received the gift, after 2 years that person died. So before 10 years and after 2 years you have to check this provision. So whatever gift tax was paid, previously paid by this person who died, they will get a credit. The estate tax paid will, like whatever gift tax or estate tax paid, they will get a credit. Got it, guys? There will be no practical question or theoretical based on this, but this is simple a logic you can read into the publication. See, actually tax is a very wide subject. Even if I talk about myself, like I'm still lagging behind in few topics. It's a very wide and a lifetime learning subject. Okay, every day some new amendments will come, every day some new things will come. But this, for passing your exams, first of all, you know, you should know these are all the base of your tax. This is the EA exam is just the base of your tax. The after achieving the degree, it will not end over here only. You have to go through so many publications, so many learning, and whatever you are learning right now, the way will change every time when you look at the publications. Okay, so next one is filing a estate tax return. Simple it is. The first time when you're going to file a 706, yeah, 706, then you have 9 months from the date of death. After 9 months, right, you can get an automatic extension of same 6 months. So you have 15 months to file the 706, file the first time the estate tax return. After that, what will happen? You have to file a 1041 return if the estate is earning more than $600. And the due date of filing 1041 is again the 15th April in case of the fiscal year is followed. And 4th month from the end of the year, okay, that is 15th April I can say, or any other month if the year is ending, it will be 4th month. But here in case of 1041, the extension time for the deadline is 5.5 months instead of 6 months. Okay, so what all gross estate will include, it is mentioned over here. So just go through it once. Okay, I'm not going to read it because this we have already done very well in the class. So just go through this theory, like what all expenses will be included in your this estate, gross estate. Gross estate is nothing but your income minus expenses. So this is your gross estate. Okay, next is I think the filing consideration, specialized return we have completed. There are still 2-3 topics. I'll just mention it quickly. Let's look at the chart, which the timetable. Okay, see, first, just give me a minute, guys. Okay, see, filing consideration we have done, dependents, innocent spouse relief we have done, injured spouse we have done, KD tax, non-resident dual status, child tax credit, child and all child and education. So whole first part is done. Second is IRA we have done, savers credit, retirement credit, pension annuities, 529, SSB, foreign related all things we have done, employee related, unearned stock dividend, itemized deduction, standard AGI income exclusion, QBI, AMT. I think AMT we have, we have missed. Just let me know in the chat box if we have missed the AMT or not. Estimated tax is done. Other tax, yeah, other taxes we have, that net investment income, all those taxes, small taxes. Yeah, AMT is also left along with that. Okay, so these 2 topics are left. Property is done, gift and estate is done. Okay, these 2 topics are just left. We'll schedule one more session where this will just take 30 minutes for me to cover, not more than 30 minutes. This is maximum I'm saying. Along with this, I'll give you the exam tips. Okay, and that recording will not be uploaded on the YouTube. So those who are right now looking at the recording, make sure to attend that day to understand the exam tips, where I'll tell you the trick of marking in the exams. And before submitting, because that at the same time you will receive a pass or fail, right? So before submitting, what you need to check, that trick I'll provide you. Calculation of the marks, take a trick before submitting your paper. But that recording will not be uploaded on the YouTube. I am again and again repeating the same thing. So please make sure, if you are looking at this recording, do attend that thing live. Okay, and this two topic will covered live only, it will not be uploaded same way. Okay, so thank you guys. I hope the all the sessions were great. If you like the session, please do comment on the LinkedIn post which I will be reposting today. Those who have already comment, no need to re-comment on it, but at least you can do this much. You can let other people know that who are going to appear in December, at least they can go through the recorded sessions. Okay, so thank you guys. We'll meet again at some other day for covering this topic. Thank you guys. Have a good day. Bye.